What does the stock market and earthquakes have in common? Well, like an earthquake, the longer it's been since the last tremor, the sooner the next one is coming. And when the next stock market correction happens, chaos will ensue. It's guaranteed. Why? Because human nature, despite great technological advancements, remains largely unchanged. Stock prices are shaped, remember, by the market's psychology. And when psychology goes bonkers, guess what happens? Share prices follow. So instead of selling at the bottom during a severe downturn, one strategy is to embrace inverse performing ETFs. Now, these are funds that are designed to increase in value when market prices fall. So instead of losing money like everyone else when prices are crashing, you actually have a chance to make a profit. Inverse ETFs are sometimes referred to as short funds or short ETFs, and they come in three basic versions. You've got the 100% daily opposite exposure, 200% daily opposite exposure, and then finally 300% daily opposite exposure. So let's just say, for example, you want to make money when the S&P 500 stock index falls. Well, check out the direction daily S&P 500 Bear 1X shares, ticker symbol SPDN. So if the S&P 500 is down by 1% on any given day, SPDN is designed to be up by 1%. SPDN, by the way, does not use any leverage to magnify its daily gains. It's one of those defensive ETFs when market prices are declining. Now, what if you want to be a little bit more aggressive because you're super bearish, you're super negative on stocks? Well, you could use a leveraged inverse ETF, something like ticker symbol SPXS, which is the direction daily S&P 500 Bear 3X shares. Now, SPXS aims for triple daily opposite exposure to the S&P 500. That means, for example, if the S&P 500 is down by 1% on any given day, SPXS should be up by 3%. Leverage inverse ETFs deliver excellent performance when market prices are sharply trending lower. And when the trend is strong and it's moving in the same direction as the way that you want to trade, that's when the leveraged ETFs are best utilized. Never, I repeat, never use leveraged ETFs in a market that is flat, neutral, or with no clear trend. More times than not, you're going to lose money on that type of trade using leveraged ETFs. It's far better to stick with sharply trending markets if you're going to use the leveraged funds. Also, if you're going to use inverse ETFs, make sure it's within the context of your non-core portfolio, which is complementary to your core portfolio. Now, you can learn more about the relationship between the core and non-core portfolio in our online classes at etfguide.com. To recap, it's better to prepare for the next market correction versus trying to accurately pinpoint the very minute when it's going to happen. I mean, that's a loser's game. The winners, they prepare ahead, they wait for their moment of victory, and when that moment arrives, they then pounce. So put inverse ETFs on your watch list and be sure to sign up for ETF Guide's free leveraged long and short ETF list. Comes out every quarter. Go to etfguide.com/snapshot and be sure to follow us on Twitter at etfguide is our handle and enroll in our online classes at etfguide.com.